Hi, this is John Kamarianos. Welcome to a new edition of Capital Considered. It is Tuesday, April 22nd as we record, and it's important to say the date, I think, on podcasts lately because economic news changes so quickly. Today, the stock market surged after plunging yesterday, and we learned after the close at 4 o'clock through Scott Bessent in an interview he gave to Bloomberg that Donald Trump, in a closed-door meeting with investors, indicated that tariffs against China, perhaps other countries, may not be severe as originally indicated. So that apparently caused the market to surge today. Hard to know with Donald Trump. Things could change from day to day. I wanted to highlight an article, however, by a Wall Street Journal columnist, James Mackintosh, who, in my opinion, is a terrific investment columnist. Mackintosh wrote about what the implications of Donald Trump's economic policies might be for investors, and to whatever extent one can isolate the economic goals of Donald Trump. Mackintosh has isolated them to: one, lower the trade deficit, and two, increase U.S. manufacturing. Mackintosh indicates that Trump has thought of U.S. citizens more as workers than as consumers, so he wants thriving industry. I think that's an interesting statement. I think no matter what you think of Donald Trump, it is perhaps useful to think that citizens are more than simply consumers, and to wonder about whether the most important economic goal is to deliver cheap prices. After all, if U.S. citizens don't have decent jobs and can't afford things, it pretty much doesn't matter how cheap prices are. So that's an interesting statement by Mackintosh. I think it's worth considering, again, regardless of what you think of Donald Trump, his character and his policies. Mackintosh also describes the mechanism of global trade for the past few decades. For years, he says, the U.S. has imported stuff, physical goods, and sent dollars out of the country. Those dollars have come back in the form of asset purchases through Wall Street, stocks, bonds, and real estate, not necessarily through capital investments. So it's not like foreign countries exporting a lot of things to the United States are taking the dollars we ship to them to pay for those things and building factories here or investing in capital goods here, as we say. They're just buying financial assets with them. Trump's plan, according to Mackintosh, will disrupt this. Smaller trade deficits mean smaller inflows of capital. Now, what are the implications of that for investors? Four big things that Mackintosh highlights, and I think he's correct. The first thing is that stuff will be more expensive. There'll be goods inflation, as well as less choice of goods, perhaps. Maybe some more government revenues as well, because tariffs serve as a tax and raise money for the government to the extent that people can pay the price increases that tariffs impose on things. Basically, Mackintosh thinks there will be a government tax increase, an increase in revenues, but things will be more expensive. There'll be goods inflation. The second thing is that there will be higher interest rates as fewer dollars are recycled back into the U.S. through Wall Street to buy financial assets. There'll be less demand for U.S. treasuries. That'll make their prices go down and their yields go up. Remember, with bonds, prices and yields move in opposite directions. And so that's actually something that Donald Trump doesn't want. He wants to keep the yield on especially the 10-year U.S. Treasury low. He wants our interest rate payments to be low. This policy could work against that, though. It could mean higher yields on the 10-year Treasury. The third thing that Mackintosh highlights is corporate bond yields could go up as well as fewer dollars are recycled back to the United States through Wall Street. And stock prices could be lower because there's less money coming from foreign countries, less recycled dollars chasing U.S. stocks. So it could be bad news for the stock market if Trump succeeds in achieving his two main economic goals to lower the trade deficit and increase U.S. manufacturing. And finally, this is something that Donald Trump does want, this fourth thing, and that is a weaker dollar. A weaker dollar means we're able to export more, and that is an implication of Donald Trump's policies. So those are the four things that James Mackintosh highlights in his recent column in the Wall Street Journal. I think they're all worth thinking about. Again, things change on a daily basis, if not a minute-to-minute basis, and we'll see where the tariffs finally shake out, or if there is a final shaking out, if they're constantly changing. My guess is if they're constantly changing, Wall Street and financial markets in general won't like that either. Uncertainty is not well tolerated on Wall Street. So Mackintosh ends his column by saying, I doubt that Trump's tariffs will bring much manufacturing back to America. If they do, investors and consumers will suffer. All of that is true, I think. It remains to be seen whether workers will benefit, which I think is Trump's goal. It may be that a whole lot of manufacturing ultimately can't be brought back. We'll have to wait and see. But that's the article from James Mackintosh. I thought it was worth highlighting. So we missed John Reckenthaler from Morningstar this week. He's a bit under the weather. He's emailed us, and we hope to have him next week or maybe sometime in the next couple of weeks. For now, this is John Kamarianos with Capital Considered signing off. Thank you for watching. Please click like and subscribe also if you like our content.